Something is happening in the silver market right now that most people are completely ignoring, and it might be one of the most costly oversights they ever make. I want you to think about something for a second. Gold just hit an all-time high earlier this year of over $5,600 an ounce. It's since pulled back. It's sitting around $4,200 an ounce right now, and everybody is talking about gold. Every headline, every financial news segment, every investment podcast. Gold, gold, gold. And in the meantime, silver is sitting at around $69 an ounce, quietly coiling, loading up like a spring that someone is pressing down harder and harder. And when that spring releases, and it is going to release, what happens to silver could make a gold rally look like a warm-up act. So today I want to take you through exactly what is happening beneath the surface, not the surface level noise, not the Twitter takes. I want to show you the structural mechanics, the historical patterns, the institutional fingerprints, and the industrial reality that is building toward what I believe will be one of the most significant silver breakouts in decades. And I want you to understand why the timing, right now, despite the recent pullback, is not a warning signal. It's an invitation. Let's start with what just happened. Silver was running hard. It ran up well above the $70 mark earlier this year. Then it pulled back. And the moment it pulled back, the sentiment shifted. People started getting nervous. The forums filled up with doubt. Some people sold. Others stayed on the sidelines waiting for confirmation. That's the classic retail investor trap. They want to buy the breakout confirmation, which means they buy after the big move has already happened. The people who actually generate wealth in these cycles are the ones who understand the setup before the crowd catches on. So let's talk about the setup, because right now, what I'm looking at technically is a textbook consolidation after a historic move. Silver ran over 130% in the previous year alone. That's not a typo. Over 130% in a single year. When an asset makes a move like that, it needs to breathe. It needs to consolidate. Latecomers get shaken out, weak hands sell to strong hands, and then the next leg begins. We've seen this playbook run over and over again throughout commodity history, and silver is following that script with remarkable precision right now. Look at where silver is trading relative to its key technical levels. The area around $68 to $70 has become a major support zone. Every time silver has dipped into this range recently, buyers have stepped in aggressively. That's not random, that's accumulation. And on the momentum indicators, you're seeing something that traders call a coil. Volatility compressing, price tightening into a narrower and narrower range, building energy for the next directional move. And given everything happening fundamentally underneath this market, the direction this coil is going to break is not a mystery. JP Morgan is forecasting silver to average above $80 an ounce for the full year. Trading Economics has a 12-month forecast of over $82. Other analysts are talking about potential moves toward $150 in an extended bull scenario. Now, I want to be clear, nobody has a crystal ball. But when JP Morgan, one of the most plugged-in institutions on the planet, is projecting a move significantly higher from current levels, that's not a rumor. That's serious institutional conviction being communicated in plain language. Quick aside here. If you're someone who is sitting on $100,000 or more in retirement accounts, and you've been watching the silver and gold market move and wondering what it means for your savings, I put together a free guide that breaks down the saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth. It's in the description below. Worth 3 minutes of your time to look at. Okay, back to why this breakout is coming. Now, here's the part that most people, even people who follow the precious metals market closely, don't fully appreciate. Silver is not just a monetary metal. It is one of the most critical industrial commodities on the entire planet. And that industrial demand story is not slowing down. It is accelerating. Fast. Let's start with solar energy. Every single solar panel that gets installed anywhere in the world requires silver. Silver is the best electrical conductor known to science. Nothing conducts electricity more efficiently at reasonable cost. When you're building a solar panel, you cannot substitute that out. You cannot use copper instead. You cannot use aluminum instead. Silver is irreplaceable in that application. And here's the scale of what we're talking about. Solar energy is projected to account for over 30% of total silver demand by the end of this decade. 30% of a 1.1 billion ounce annual demand market, just from solar panels. That number was in the single digits just a few years ago. This is an exponential demand curve that is just now beginning to mature. Then you have electric vehicles. Every EV on the road uses silver in the circuit boards, in the battery management systems, in the charging connectors, in the sensors. As the global auto fleet transitions toward electric propulsion, each additional vehicle sold is an additional demand claim on the silver market. Multiply that by tens of millions of vehicles globally, and you're talking about a demand force that simply did not exist at this scale a decade ago. And then there's AI. The data centers powering the artificial intelligence revolution, the ones processing billions of queries, training massive models, running inference at scale, they are filled with silver. The circuit boards, the connectors, the thermal management systems, every server rack in every data center represents a silver demand sink that is growing quarter over quarter with no ceiling in sight. So you have solar, you have EVs, you have AI infrastructure, you have traditional industrial uses in medical devices, water purification, industrial machinery, and running underneath all of this is a supply situation that can only be described as structurally broken in the most bullish way possible for the price of silver. Here's the thing about silver mining that most people don't understand. 70% of all silver that is mined every year comes out of the ground as a byproduct. It's not primary silver mining. It comes out when you're mining copper or zinc or lead or gold, which means that silver supply cannot be turned on and off like a faucet based on the silver price. If the silver price doubles, you cannot simply call up a zinc mine and say, mine twice as much. The zinc mine is running based on zinc economics. Silver comes along for the ride. That structural ceiling on supply is one of the most powerful dynamics in this entire market, and it is fundamentally invisible to the mainstream financial press. The result of all this? The silver market has now been in a structural supply deficit for 6 consecutive years. 6 years in a row where demand has exceeded what the world can produce. In a single recent year, demand outpaced supply by over 500 million ounces. This year, analysts project a deficit of 65 to 70 million ounces, even after accounting for recycling and all secondary supply sources. When you have a market running a sustained deficit for that long, and you have the demand accelerators I just described still in their early innings, what do you think happens to the price? Now let's talk about the gold-silver ratio, because this is the number that really puts everything into perspective. Right now, gold is trading at around $4,200 an ounce. Silver is trading at around $69 an ounce. Divide those two numbers and you get a gold-to-silver ratio of approximately 61 to 1. What that means is it takes 61 ounces of silver to buy 1 ounce of gold. Throughout most of modern financial history, that ratio has averaged around 50 to 1 in flat markets and compressed dramatically, sometimes to as low as 30 to 1 or even lower during precious metals bull markets. Go back to 1980, the last time silver had a massive historic bull market run. The ratio dropped to around 15 to 1 at the peak. Now, I'm not saying we're going to 15 to 1. I'm saying we don't even need to get close to that number for silver to dramatically outperform gold from here. If the ratio simply compresses from 61 to 1 down to 40 to 1, with gold staying where it is at 4,200, silver would be over $105 an ounce. And if gold continues its own trajectory higher, toward the levels Goldman Sachs and JP Morgan are projecting, and the ratio compresses even modestly, the math gets very exciting very quickly. This is not speculation. This ratio compression has happened in every major precious metals cycle in recorded history. When monetary stress increases, when inflation persists, when geopolitical uncertainty flares, both metals move, but silver historically moves faster and further in percentage terms. Gold gets the headlines, silver gets the returns. And speaking of monetary stress, let's talk about what's happening in the macro environment right now, because this is the third leg of the stool that makes this silver breakout setup so compelling. We have inflation running above the Federal Reserve's target. We have central banks around the world that are not reducing their gold reserves, they're increasing them. Central banks bought 244 tons of gold in just the first quarter of this year alone. 244 tons. These are the most sophisticated financial institutions on the planet. Institutions that have access to every research report, every economic model, every policy briefing that exists. And they are not diversifying out of precious metals. They are accumulating. That tells you something profound about what the people at the highest level of global finance think is coming. The Federal Reserve recently signaled it may need to hike rates again because inflation is proving stickier than expected. The headline inflation rate is running above 4%, driven significantly by energy prices that got supercharged by geopolitical tensions in the Middle East. Now, here's something important to understand. When the Fed signals rate hikes, precious metals typically pull back short term. We saw that happen. Gold dropped nearly 2% on that news. Silver followed, and the mainstream financial press spun it as bearish for precious metals. But here is the reality that the professionals understand. The Fed is behind the curve. They have been behind the curve for years. Inflation at 4% with rates where they are means real interest rates are still deeply negative. When you account for actual consumer price pressure, the purchasing power of the dollar continues to erode. And every time the dollar weakens, every time real rates are negative, precious metals are performing exactly the function they were designed to perform, protecting purchasing power. You want to understand what real inflation looks like? Go to the grocery store. Go fill up your gas tank. The official CPI numbers are measuring something, but they are not measuring what everyday Americans are experiencing in their wallets. And when people start to feel that gap between what they're told inflation is and what it actually costs to live, that is when the rush into hard assets accelerates. We are not at peak precious metals mania yet. We are not even close. The people who get in before that mania phase are the ones who look back on this moment as one of the best decisions they ever made. Now, let me talk about something that very few analysts cover: the paper silver market versus the physical silver market. Because what happens at the COMEX, the major futures exchange where silver is traded, is one of the most extraordinary structural distortions in any market that exists today. On any given trading day, the amount of silver that changes hands in paper futures contracts, contracts that represent silver that may or may not physically exist, dwarfs the amount of actual physical silver available for delivery. We're talking about a market where, for every single ounce of physical silver sitting in registered COMEX vaults, there are dozens, sometimes hundreds of paper claims on that ounce. This system works as long as most of those paper holders never actually ask for delivery. They just roll the contracts, they trade the paper, they never take the metal. But here is what happens when physical demand gets strong enough that it strains that system. When industrial buyers can't get silver fast enough and start drawing down physical inventories. When retail investors start demanding the actual metal, not just exposure to the price. When the cost to borrow silver to cover short positions rises dramatically, as it has been rising. What happens is a short squeeze, a violent repricing where the paper market is forced to reconcile with physical reality. And the historical examples of when this has happened: look at what happened to silver in late 1979 going into 1980. In roughly a year, silver went from around $6 an ounce to nearly $50 an ounce. That is a price move of more than 700%. The conditions that drove that move were a combination of inflation fears, dollar weakness, geopolitical tension, sound familiar? And physical demand overwhelming a paper market that was structurally short. The Hunt brothers became famous for that episode, but what actually drove the majority of that move was not the Hunts. It was an entire global investor class simultaneously reaching for physical silver at a moment when supply could not keep up. The Hunts just happened to be the largest single actor in a stampede that was already underway. Now, I'm not saying we get a replay of exactly that scenario. What I am saying is that the structural preconditions, a paper market that is massively extended on the short side, physical inventories that have been trending lower, industrial demand that is non-optional and growing, these conditions are present right now in a way that they have rarely been present simultaneously. Here is where I want to bring this back to something very personal, because I know that a lot of people watching this are not 25-year-old traders looking to flip silver futures for a quick profit. A lot of you are Americans in your 50s or 60s or 70s who have spent your entire career building retirement savings that you are now trying to protect. You've watched inflation eat into the purchasing power of your savings. You've watched stock markets go through violent corrections. You've watched everything you thought was stable turn out to be less stable than you thought. And now you're wondering, what do I actually do with all of this? For people in that situation, people who have accumulated real wealth in retirement accounts and need to protect it over the next 10 to 20 years, the story I've just told you about silver is not just an investment thesis. It's a structural argument for why holding some exposure to precious metals is not speculation, it's prudence. The same forces, inflation, dollar debasement, geopolitical instability, central bank policies that prioritize short term market management over long term monetary discipline, all of these forces simultaneously act as tailwinds for silver and headwinds for the purchasing power of paper currency sitting in a bank account or a bond portfolio. A gold IRA is one of the ways that some American retirees have been getting physical precious metals exposure directly inside a tax-advantaged retirement account. I bring it up because it's not widely understood that you can actually hold physical gold and silver in an IRA structure without triggering tax penalties, if it's set up properly. If you've got 100,000 or more sitting in a 401k, an IRA, or any other retirement account, and you want to understand what a metals allocation could actually look like for your specific situation, not a sales pitch, just education. That's exactly the kind of thing you can get real clarity on. We'll come back to that at the end. Back to the breakout. Let's talk about what's happening with institutional money right now, because the institutional footprint in silver is telling a story that retail investors almost never see until it's too late. Look at the flows into silver ETFs. Look at the positioning data from the CFTC Commitment of Traders reports, where you can actually see what the commercial traders, the big banks and financial institutions, are doing with their silver positions. What you've seen over recent reporting periods is commercial short positions declining from extreme levels. That's a significant signal. Commercial traders are the smart money in the futures market. When they begin covering short positions, when they start pulling back from bets that the price will fall, it means they are seeing something in the physical supply-demand data that tells them the short trade is getting dangerous. At the same time, institutional money managers, the hedge funds, the family offices, the sovereign wealth funds, have been increasing their long exposure. The flow of physical metal into allocated accounts, accounts where you own actual silver bars, not a paper claim, has been accelerating. When smart money starts moving in before a breakout, you typically don't see it in the price immediately. It happens quietly in the plumbing of the market, in the vault allocations and futures positioning and option skew. By the time it shows up in the price chart in an obvious way, the easy money has already been made. And then there's the geopolitical dimension, which right now is providing a constant pressure on the accelerator pedal for precious metals. The reopening of the Strait of Hormuz following the US-Iran interim agreement temporarily eased some of the energy price pressure. But the deeper geopolitical story, the one that's been building for a decade, is about the fragmentation of the dollar-based global monetary order. BRICS nations are expanding. Central banks in the global south are diversifying away from dollar reserves into gold. Trade flows are being restructured around non-dollar settlement mechanisms. The petrodollar arrangement that has underpinned American economic hegemony since the 1970s is showing genuine cracks for the first time in its history. And every crack in that system is effectively a vote of confidence for precious metals. You can argue about the pace of de-dollarization, you can debate how fast or slow this transition happens, but the direction is not in dispute among serious monetary economists. The dollar's share of global reserves has been declining for years. The demand for an alternative store of value, one that cannot be printed, cannot be sanctioned, cannot be frozen in a bank account, is not going away. Gold and silver have served that function for 5,000 years of human history, across every civilization and every monetary system that has ever existed. They are not going to stop serving that function now. So let me bring all of this together and give you the picture as I see it. You have silver at roughly $69 an ounce, significantly below the highs it reached earlier this year. You have a structural supply deficit that has been running for 6 consecutive years. You have industrial demand from solar, EVs, and AI infrastructure that is growing exponentially with no substitution alternative. You have a gold to silver ratio of about 61:1 that is historically distorted in a way that is always corrected, and when it corrects, silver dramatically outperforms gold. You have institutional accumulation quietly underway. You have a paper market that is stretched on the short side and increasingly vulnerable to a physical squeeze. You have an inflationary macro backdrop with a central bank that is struggling to restore credibility, while negative real interest rates continue to destroy the purchasing power of paper savings. And you have geopolitical fractures in the global monetary order that are providing structural, multi-year tailwinds for hard assets. The breakout is not a question of if. Every analytical framework I use, technical, fundamental, institutional, historical, is pointing in the same direction. The question is only when. And the great irony of markets is that the moments that look most uncertain The pullbacks, the consolidations, the moments when sentiment shifts and the commentators start second guessing the trend, those are precisely the moments that the biggest opportunities get created. The people who understand this are the ones sitting on the other side of the trade from the people who panicked out of a position they should have held. Right now, you have a window. Not a permanent window, not an infinite window, but a window where silver can still be acquired at a price that, when you look back months from now, is going to look extraordinarily reasonable relative to where this market is heading. Once the next breakout leg begins, and I believe we are in the late stages of this consolidation, the move is going to be fast. These markets do not give you time to deliberate once they start moving. That's why the work has to be done now, in the quiet before the storm, when most people are distracted by short-term noise and missing the long-term signal. I appreciate you watching all the way through, and if you've made it this far, I want to offer you something specific. The guide in the description below is the same framework that thousands of American retirees have been using to quietly protect their hard-earned wealth during this period of monetary uncertainty. It covers saving strategies, metals allocations, and how to think about protecting purchasing power in a way that doesn't require you to be a professional trader. It's free, it's detailed, and it's in the description right now. And for those of you with $100,000 or more in any retirement account who are watching this and want to actually sit down and talk through what this means for your specific situation, if you mention that you watched this video, you can get an exclusive complimentary one-on-one educational web conference at no obligation. That's available specifically for American retirees with at least $100,000 in retirement savings. The link is in the description. Do not wait for the confirmation candle on the chart. By then, every retail investor in the world will be chasing the same move. The time to understand this market and position accordingly is right now, before it becomes obvious. The silver breakout is closer than you think, and the people who act on that understanding before the crowd recognizes it are going to have a story to tell on the other side of this move.